Is a 2025 housing crash actually coming, or are we just falling for the hype? With prices rising and mortgage rates squeezing buyers, many are wondering if we're heading for a collapse like in 2008.
But what does the data really say? Stay tuned as we dig into the numbers and uncover the truth.
Like, share, and subscribe for more updates that actually break it down without the panic. The supply and demand gap remains a key factor. Despite all the talk about a potential crash, one thing is clear in 2025: the housing supply still isn't meeting demand. According to recent data from the National Association of Realtors, the U.S. is short by more than 4 million homes. Construction has picked up slightly, but not fast enough to keep pace with population growth. Millennials, many now in peak buying years, are flooding the market with serious intent. Builders face challenges from high material costs and labor shortages. Meanwhile, existing homeowners are reluctant to sell due to low locked-in mortgage rates. This imbalance is driving prices higher, not lower. Until supply significantly exceeds demand, a dramatic market-wide collapse remains highly unlikely based on the current fundamentals. Higher mortgage rates are slowing growth, not triggering a collapse. In 2025, mortgage rates hover between 6.5% and 7%, much higher than the pandemic's sub-3% rates. This increase has certainly cooled demand, but it hasn't caused the market to collapse. Higher borrowing costs are slowing investor overreach and deterring some first-time buyers in expensive cities, but they also prevent runaway bidding wars. Home purchase applications have dipped slightly, but there's no evidence of a dramatic pullback. Refinancing has dropped sharply, yet overall housing activity remains relatively stable. These rates are functioning like a market stabilizer, encouraging a healthier pace of transactions. Instead of triggering a cliff fall, the current mortgage landscape appears to be pushing the market into a more sustainable and measured direction, just as the Federal Reserve hoped. Homeowners hold strong equity positions. Unlike the conditions leading up to 2008, homeowners in 2025 are sitting on significant equity. According to CoreLogic, the average mortgage holder has gained over $270,000 in home equity since 2010. Even after minor corrections in 2023 and 2024, most homeowners remain far above water. Fixed-rate mortgages dominate, and roughly 40% of homes are owned free and clear. This financial buffer discourages panic selling and makes large-scale foreclosures far less likely. When people have equity, they're less likely to walk away or dump properties quickly. That's a massive difference compared to the last housing crash, where negative equity was rampant. This time, homeowners are in a much stronger position, reducing the chance of a market freefall.
Delinquency and foreclosure numbers stay low. If a crash were around the corner, we'd expect to see defaults and foreclosures rise, but in 2025, that's not happening. National delinquency rates are near 3%, historically low, thanks to tighter lending rules and better financial education. Most borrowers today are well qualified. Foreclosure rates have remained stable, and there's no indication of a major spike. Homeowners are still paying their mortgages even after pandemic-era forbearance programs ended. Employment levels remain strong in most regions, supporting borrowers' ability to stay current. Without a wave of foreclosures or distressed properties flooding the market, we're unlikely to see a broad housing collapse. Affordability is painful, but not a crash trigger. There's no denying it, affordability is a serious issue in 2025. Median home prices have surpassed $420,000, and mortgage payments often consume more than a third of household income. But while this limits who can buy, it doesn't automatically trigger a crash. Sellers are adjusting their expectations, offering incentives or waiting longer rather than dropping prices dramatically. Meanwhile, remote work continues to fuel migration to cheaper cities, distributing demand more evenly across the country. Yes, affordability slows the market's pace, but that's different from a collapse. Unless unemployment spikes or inventory balloons unexpectedly, the current strain on buyers is more likely to result in stagnation, not a housing market meltdown. like some fear. Investor pullback is rebalancing the market. During the pandemic, investors, especially institutional ones, poured into the housing market, accounting for nearly 20% of purchases by 2022. Now in 2025, that share has dropped as higher interest rates and tighter regulations cool investor appetite. According to Redfin, investor purchases have declined more than 40% since their peak. Still, they remain active, especially in rental markets and build-to-rent communities. Many are now long-term holders instead of short-term flippers, which reduces volatility. Investors are watching closely, but aren't dumping properties en masse. This controlled reduction in investor activity helps normalize the market rather than destabilize it. Unless a massive liquidation occurs, something not currently reflected in the data, investor shifts are unlikely to be the trigger for a market-wide crash.
Different regions show different stories. Housing markets in 2025 are highly regional. Cities like San Francisco, Boise, and Austin saw major gains in recent years and are now seeing 10 to 15% declines. But many places in the Midwest and Southeast remain stable or are even appreciating. Zillow data shows 60% of metro areas still recording price gains, albeit slower than in 2021 or 2022. Each city's performance depends on local factors, like job availability, migration patterns, and affordability. National averages can be misleading. These localized corrections help reduce overheating, but aren't evidence of a widespread crash. It's a patchwork, not a panic. Wages are rising, but not fast enough. Although wages have been increasing, especially in fields like healthcare, tech, and skilled trades, they haven't matched the speed of housing price growth. Since 2020, home prices have jumped over 35%, while wage growth is closer to 20%. This mismatch is deepening the affordability crisis and pushing many potential buyers into the rental market. Builders are responding with more affordable housing options, including townhomes and multifamily units. Still, the wage gap restrains price growth, but it doesn't inherently lead to a crash. If job numbers stay strong and buyers can adjust their expectations or relocate to more affordable areas, the market can keep functioning. Wage stagnation limits growth, but it doesn't spell doom unless paired with job losses or economic shocks. Buyer sentiment and market psychology play a role. Fear of another housing crash often comes more from emotion than actual data. Memories of 2008 still linger, and many people are quick to assume the worst. But behavioral experts say this is a classic case of recency bias. When buyers expect prices to fall, they hold off on purchasing, which can temporarily slow activity. Social media also amplifies panic by sharing worst-case stories. But if you look at the real numbers, inventory, foreclosure rates, employment, there's no major red flag. Emotion plays a role in short-term decision-making, but long-term trends still rely on fundamentals, and those fundamentals remain relatively strong. So, will 2025 bring a housing crash? The evidence says no. While some markets are cooling off, most data points to a slowdown, not a meltdown. Strong homeowner equity, limited inventory, and stable foreclosure rates are key indicators. Thanks for watching. Don't forget to like, share, and subscribe for more videos like this. Drop your thoughts in the comments. What do you think the future of housing looks like?